We looked at chapter 16, which deals with retained earnings and earnings per share. And today we're going to look at some tutorial questions. Hopefully, these are the exact tutorial question of the last semester. For some reason, there are two files missing from my flash drive. So I'm hoping that I selected the exact same tutorials as I would have done with the last class. In class. Now the file is not able to open it. My money was on top of it, this smart boards. No?
Wait, it is. March. Yay! That's once.
What was the first tutorial question? Huh? The same one? So let's look at E16.1.
this page. Search. What is search?
A61 deals with different types of dividends.
Alright.
Caroline Company listed the following items in its December 31st, 2018 financial statements. And they've given us a list of them. Investments, dividends payable, preferred and common, what is the preferred stock at par and common stock, and the additional paid-in capital for both along with the retained earnings. During 2019, the following transactions happened, and we have 7 transactions to look at. They've asked us to prepare the journal entries to record each one of the transactions. Starting with February 2nd. They paid semi-annual dividends declared on December 15, 2018. So here they are paying dividends. According to this, the preferred stock is at 8%, and then we have the common stock. How would we go about paying the dividends? Well, no. They're paying the payables. So here they had the dividends payables preferred, 4,000, and dividends payable common stock, 40,000. So they had already given us the payable accounts. So they're paying on this obligation. So if they're paying an obligation, you debit the liability and you credit cash, since it's cash that they're paying with and not property or anything else. So debit each one of the dividends payable and credit cash for the sum of the two. On March 5th, declared a property dividend payable to common stockholders on April 5th in main company bonds being held to maturity. The bonds, which have a book value of $25,000, have a current market value of $31,000. So here, they have declared dividends, but they're using property, so it's a property dividend. And this is going to our common shareholders. So when it's property dividend, it affects our retained earnings. But the first thing we're going to look at, these bonds have a book value of $25,000. But currently, the fair value is $31,000, so it is higher than book value, so there's a gain. $31,000 minus the $25,000 is a $6,000 difference. So here, they're going to debit the investment on the company bonds for the $6,000 because of that gain, and credit gain on disposals of investment for the $6,000. Then they are now going to create the obligation of the property dividend payable by reducing the retained earnings. So once it's a property dividend, we reduce the retained earnings for the $31,000, which is the fair value or market value, and credit property dividends payable. So here there's 2 transactions that happens when there's a property dividend. We first have to check, do we have a gain or a disposal on the property that we're giving up for the dividend payment? In this case, your book has $25,000, but the market value is $31,000, so it has increased. Since it has increased, we know we have a gain of $6,000. So since the value went up by $6,000, we are going to debit the investment account for the $6,000 and credit the gain on disposal $6,000. Then we are now going to transfer the property that we're giving them by reducing the retained earnings for the market value, not the book value, of $31,000, and crediting property dividends payable 31,000. Any questions?
If there was a loss instead, would it be?
Debit the loss on disposal and reduce the investment by crediting it. April 5th, paid the property dividend. So this property dividend that you have, what are we doing? We're paying, which means we're transferring the property over. So you're going to debit the property dividend payable because you no longer have this obligation and reduce the investment in main company bonds 31,000. So you no longer have the payable and now you no longer have the investment. July 6th, you declared a $4 per share semi-annual cash dividend on preferred stock and a 1.10 per share semi-annual dividend on common stock, which you're going to pay on April 17th. So here you have declared dividends, but you're not paying it until a later date, so you have to create the obligation. Once you declare dividends and you have not paid, that amount is going to reduce our retained earnings. How much are we reducing retained earnings for? First, we have to identify how many shares of preferred stock do we have issued and how many shares of common stock do we have issued. And to do that, we go back to the information at the top. At the top, it says that our preferred stock total was 100,000. That's the dollar value. But each one of those preferred shares has a par value of what? 100. So 100,000 divided by 100 will give you that we have 1,000 preferred shares issued. You do the same for common stock. According to this, we have 400,000 common stock in dollar value. Each one of these stock is a $10 par value. 400,000 divided by 10 will represent 40,000 shares of common stock. So now that we have calculated what's our shares issued and outstanding, you then multiply by the dividend cash amount. They said preferred stock has $4 and common stock is $1.10. 1,000 times 4 is 4,000 and 40,000 times 1.10 is 44,000. So now you are going to debit the retained earnings to the sum of both, which is 48,000, and then create dividends payable preferred, 4,000 credited, dividends payable common, 44,000 credited. So in order to have done this, you first would have had to calculate, since the exercise didn't give us, how many shares do we have issued? And to calculate that, what's the total dollar value of our shares and what is the par value? Take that total dollar value and divide by par, and that will give you how many shares you have issued. Once you calculate that, you multiply by the cash dividends per share amount.
Why do you keep saying semi-annual just to throw us off this?
No, that's how they choose to pay dividends, twice a year. They don't wait till the end of the year.
Okay.
August
You made me
17th.
think of dividing it by 2 and all that.
Oh, no.
Yeah.
August 17th, they paid the cash dividends. So the journal entry that you did on July 6th, you're now paying on the date, which is August 17th. So what we're going to do, clear out the obligations by debiting back the accounts and crediting cash for the total paid out. October 15th, we declared a 2% stock dividend on common stock to be issued on December 3rd. The current market price is $22 per share. So here we have a stock dividend that we are giving 2% of our uncommon stock. How many common stocks do we have issued and outstanding? We calculated it above. We have 40,000 shares. Of that 40,000 shares, we're declaring an additional 2%. The current market value of those shares are $22. 40,000 times the 2% times the market value of $22 will give us $17,600 to retain earnings. But remember, those common stock has what? A par value of $10. So therefore, 2% of 40,000 is, somebody do a quick math there for me, please.
800.
800 shares times the par value of 10 is 8,000. So common stock to be distributed in the future, 8,000. And the difference between the 17,600 minus the 8 is what will go to additional paid-in capital from stock dividend. So again, here they declare a 2% stock dividend on the common shares. So what do we need? How much total shares of common shares do we have issued? We calculated it before, it was 40,000. 40,000 times the 2% that they're now going to issue times the market value of $22. That gives us the total amount to reduce our retained earnings. However, the credit common stock to be distributed, we have to multiply that by the par value. 2% of 40,000 shares is 800 shares. So that's the additional shares they're giving out, 800. 800 times par value of 10, 8,000. And then the difference, additional paid-in capital for common stock dividend. December 3rd, issue the stock dividend. So this stock dividend that we did declare on October 15, we're now issuing. Therefore, the common stock to be distributed is no longer, because now we are distributing it, so we are going to debit for the 8,000 and now credit common stock $10 per 8,000. So the first one in October 18, we have not distributed, hence we have common stock to be distributed. When you're now distributing, you have to clear up the account and transfer it to the actual common stock equity account. Any questions? December 28th, we declared a $4 and a $1.20 per share semi-annual cash dividend on preferred and common stock respectively to be paid the following year. So since we're not paying it and we're just declaring, we create the liability. How do we create the liability? How many preferred stock do we have issued to date? Still 1,000. 1,000 times $4 is $44,000 payable. How many common shares do we have today? We have the 40,000 we started with plus what? The additional 8 we would have distributed. So currently we have 40,800 shares of common shares outstanding. Take that and multiply it by $1.20, we're going to get 48,960. So our journal entry would be a debit to retain earnings for the sum of both, 52,960, and a credit to dividends payable preferred stock, 4,000. Dividends payable common stock, 48,960. Any questions with any of the journal entries? Do I need to go over any one of them specifically? What was the next exercise? Well, you have to go back and face this. Is it E16.6?
Yes. Yes.
E16.6. We're going to look at the prior period adjustment. Story Company began 2019 earning balance of 142,400. During an examination of its accounting records on December 31st, 2019, he found it had made the following material errors for both financial reporting and income tax reporting during 2018. So in 2019, you're realizing there were errors you made in 2018. Depreciation expense of 15,000 inadvertently had been recorded twice for the same machine. So here you have, in 2018, you would have depreciated your, or calculate or done the journal entries for depreciation twice. If you booked an entry twice, which depreciation is an expense, what is the effect at the end of 2018 on your net income?
It's too much.
Let's say depreciation was 6,000. You did debit depreciation expense 6 and you credited accumulated depreciation 6. But you did it again. What is the effect on your net income by booking that entry a second time?
It's too much.
It's understated.
Understated.
Because you have reduced, which an expense reduces. So you would have reduced. And if you would have reduced, if your net income is understated, what's the effect on income tax? It's also understated because remember income tax is a what? Percentage of your net income. So if your net income is understated, so will be income tax. 2. No accrual had been made at the year end for interest. Therefore, interest expense had been understated by 4,000. Same thing. Since you did not record the interest expense, what's the effect of your net income? Your net income is further understated, which means income tax. No, overstated, because you did not record the 4,000, so you have too much income. And if your net income is overstated, your income tax will also be overstated. So the net income before taxes during 2019 was 60,000. The company has been subjected to 30% income tax rate for the past several years. It declared and paid dividends of 13,000 during 2019. Prepare whatever journal entries are necessary to correct the 2 previous errors. Make your corrections directly to the retained earnings statement. So here, what is the first error? The first error is we would have recorded depreciation of 15,000 inadvertently twice. So in 2018, we recorded it twice. So now we have to do what? Take out 1. But since we're in 2019, we can't take it out from the expense because it's not an expense of 2019. We have to take it out from the retained earnings, which is what? An accumulation of net income and losses over the years. So we're going to debit accumulated depreciation 15 because that's on the balance sheet, so that we can reduce that additional 15,000 we had put in and credit the retained earnings for 15. When it comes to any correction that deals with revenue and expenses of a prior period, retained earnings is what you're going to debit or credit. If it's a balance sheet item, then you can make the entry directly to the balance sheet. So in 2018, when you debited depreciation expense and credited accumulated depreciation, for the additional 15,000, to correct it, essentially you're going to reverse that entry. Debit the accumulated depreciation 15,000, but since you're in the next year, you are going to credit retained earnings 15,000. If you had picked up this error in the same year that you made the error, you'd have simply debited accumulated depreciation 15, credited depreciation expense 15. But it's not in the same year, so therefore it must go to retained earnings. The second entry is so that's to correct the net income issue. Now we have to look at income tax. What do we have to do? Since our net profit or loss, whatever they would have had, is now understated, understated by 15,000, you would have paid a 30% on the understatement. So how do you correct the tax issue? 30% of that 15,000 will go to retained earnings debited, 4,500, and credit income tax payable on prior earnings, 45. Why a credit? Because when you did it in 2018, you calculated less taxes. Less taxes, right? Right, because it was on the expense would have reduced income, and so you would have had a lower income tax. Right. So you would have calculated it on less taxes. So because your net income was less and you gave them less money, now that you make the correction, you have to give them back the money. So in this case, you will debit the retained earnings from that 30% that should have been paid in, which would have been income tax expenses, and you need to credit the payable if you're not paying yet. If you are paying on the spot, you would credit cash. But we'll just assume that it's not. I mean, if you find the error now, you're not paying now, so it is the payable account. 2. What happens to the interest you didn't record? By omitting to record the taxes for the interest, your net income is overstated. Had you done it in 2018, you would have debited interest expense and credited interest payable. But since you're identifying it in 2019, you cannot debit interest expense. We must debit retained earnings for the 4,000, credit the interest payable 4,000. And of course, that taxation that didn't happen, what are we going to do? Calculate 30% of that 4,000, which is an additional $1,200 in $1,200. But in this case, since it's an expense that you forgot to record, you'd have paid a higher income tax because it wasn't there. So if you paid a higher income tax, this $1,200 is going to reduce it. Therefore, debit the income tax payable on prior earnings, $1,200, and credit retained earnings, $1,200. Any questions with the journal entries or calculations? No. The second part of the exercise prepare the retained earnings segment for 2019. So we start with beginning retained earnings previously reported January 1st, 142,400. But because of these errors, we now have to make prior period adjustment. Correction of the overstatement in 2018 depreciation. How do we do the correction? 10,005. Where did they get that? 15,000 credit minus 4,500 debit. The net amount will go to the retained earnings, 10,500. Correction of the understatement in interest. So we would have debited retained earnings 4,000 and we would have credited for 1,200. 4,000 minus 12 is 28, but the debit is greater, hence a negative 2,800. Remember, debits are negative when it comes to retained earnings, credits are positive. So you have a negative 4,000 plus that positive 1,200 leaves us with negative 28. We add the 3 and that gives us what should have been the adjusted retained earnings at the beginning of 2019. And then now we can add the net income of 2019 minus the cash dividends in 2019 to get what is the ending retained earnings of 2019. So again, when you're asked to update and correct, you start with what was the retained earnings with all the errors. That was 142,400. What prior year adjustments did we do? If you wanted to list all 4 of the retained earnings here, you could have done that. So in other words, you could have said add the 15,000, another line minus the the 4,500, you could have done them separate if you wish. You still want to be the same thing. You just need to make sure that you have them plus and minus signs correct. In this case, the first two deals with the same thing, so we can net them off. Positive 15,000 minus a debit of 45, 10,500. The second error, we had a negative 4,000 on retained earnings, but a positive 1,200 on retained earnings, so the difference between leaves us with a negative 28. When you add the retained earnings with the errors, plus the two corrections that you did, your correct retained earnings for 2019, January 1st, 150,100. They gave us the net income for the year, so we add net income. They gave us the dividends of 2019, so we subtract, and that leaves us with the ending retained earnings of 2019. Any questions? No. I have 16.8.
Yeah.
16.8. World's company began 2019 with a 120,000 balance in retained earnings. During the year, the following events occurred 1 to 5. Prepare retained earnings statements for the year ended December 31st, 2019. Prepare disclosure note to disclose the restriction of retained earnings. So they've asked us to do a statement. So we know the retained earnings always start with the beginning retained earnings, and they said they began with 120,000. We need to go through all of these to see, is there any correction to be made from the previous year? So the first one, the company earned net income of 80,000. We know that's our net profit that we're going to add at some point. 2, a material error. A material error in net income from a previous period was corrected. So here we have to make a prior period adjustment. This error correction increased retained earnings by 9,800 after the related tax of 42. So the correction will increase retained earnings, which is 9,800. So that 9,800 is added. Then we get 3, cash dividends. So we know that's coming at the bottom that we're going to subtract. 4, 1,000 shares of callable preferred stocks that originally had been issued at 110 were recalled and retired at the beginning of the 2016 for the call price of $120 per share. So here, we are retiring preferred stocks. So the preferred stocks that they say that we're retiring, which means we're getting rid of them. And if we're getting rid of them, it's going to reduce. So we're going to get to that. Treasury stock was acquired at a cost of 20,000. State law requires a restriction of retained earnings in equal amounts. The company reports the retained earnings restrictions in the note. So this restriction does not go to the retained earnings statement because it says the company accounts for it in simply a disclosure note. So now that we've gone through all 5 situations, the first things first. The correction that increased we would have done so we can get our adjusted retained earnings. There's no other prior year, so what's the next thing you do? To add your net income. After you added your net income, we're going to subtract 1, our cash dividends of 13,000 and our stock dividends of 17,000. Cash dividends minus 13, stock dividends minus 17. And then the retirement of the preferred stock. How many preferred stock are we retiring? It says that we are retiring 1,000. They were originally issued at 110, but the call price was 120. Therefore, 120 minus the 110 is $10. So 1,000 times 10, 10,000. We have nothing else to subtract or add, so we do the totals. And our ending retained earnings, 169,800. As for the restriction, because the company simply account for it in a note, you simply put a disclosure note, retained earnings are restricted in the amount of 20,000, the cost of the common shares that's being held as treasury stock. Any questions? E1611. Changes in shareholders' equity. The shareholders' equity section of Flores Design Company December 31st balance sheet is as follows. So they've given us the balance sheet, how it looks on the balance sheet. Then they say June 2019, they gave us 5 things that happened. Prepare the shareholders' equity for the year ended December 31st, 2019. So the first information at the top, since this is December 31st, 2018, we know that these account balances is what we start 2019 with. So we head up, shareholders' equity, the name of the company, the name of the statement for the year December 31st. First column is all the demand for the description. Then we know that they have both preferred and common stock. Preferred stock is first. So here, the number of shares issued and their par value. Then we have columns for common stock, the number of shares issued and the par value. Then we have additional paid-in capital for preferred stock, common stock, and treasury stock. After that, we have retained earnings, and we have treasury costs, which is your treasury stock. So those are based on the balances that we have that we're going to use. The ending balances of 2018 is our January 1st, 2019. Starting with preferred stock. How many shares was issued according to this 1250? At a value of 125,000. So we just put in back the information from the balance sheet that's here. Common stock 15,000, 150,000 value. The additional paid-in capital and preferred stock 55. The additional paid-in capital and common stock 105,000. We don't have any additional paid-in capital and treasury stock at the beginning, so that's 0. And our retained earnings. At the beginning of the year, 78,000. So we put that in. And our treasury stock, a negative 4,200. So now we look at what happened during the year. First thing, 1, issued 250 shares of preferred stock at 164. Preferred stock has a par value of $100, which means you're issuing it for $64 more. 100 times 250 is 25,000. Therefore, 64, which is the additional, times 250 will go into additional paid-in capital on preferred stock, 16,000. I believe the calculations are somewhere.
Yeah.
No, I can't see that.
It's right there, below the
Oh,
balance.
right here. Next one. Issued 3,000 shares of common stock 17. These common stock have a par value of 10. So therefore, 3,000 times 10, 30,000. $7 excess will go to where? Additional paid-in capital. So 7 times the 3,000 will give you 21,000 under the additional paid-in capital of common stock. 3, reacquired 200 of its own common shares as treasury stock for $15. So here, out of all of those common stock that you have, you are taking back, reacquiring buyback, 200 of that. 200 times 15 is that 3,000? It's 3,000. Therefore, when it comes to treasury stock, we know it reduces your overall capital base, hence it is negative. So it's negative 3,000. You reissued 250 of the treasury stock. So of all the treasury stock that you took back, somehow you're reissuing now 250 at 17, using the FIFO basis. What does that mean? In the transaction before, we would have we acquired 200 shares, but it says FIFO. In other words, that balance of 4,200, that's where we're going to start. That 4,200 represents how many shares we acquired, and we go back to the table, to the balance sheet. So it said we had 300 shares of common stock of $14 per share, which is negative 42. So since we are now reissuing 250, it's going to come from that 300 that you started with. Therefore, 300 times 300 times 17 is what? Not 300, sorry, 250 times 17. How much? 250. How much did we? Oh, 14. 250 times 14 is what? 3,500. So when we would have reissued those 300 shares, it came at a par value of 14. We're now reissuing 250 from that, so we reissue at the par value, reduce at the par value of the 14. So 250 times 14 is 3,500. So since we are selling them back, that's positive, so that would be a positive 3,500. And then 5, net income for 2016. I think this is a typo. It's not the year, it is 2019.
Okay.
So this has to be a typo. So the net income for 2019 was 46,500. Net income affects who? Retained earnings, so that goes on the retained earnings section as a positive 46,500. We also have dividends distributed of 25,000. Dividends reduces who? Retained earnings, so it's over there as negative. There's nothing else to take into account, so now we add all of our balances. So we now have 1,500 preferred shares at the end for 150,000. We now have 18,000 common shares at 180,000. Preferred stock additional paid in capital 71,000. Common stock 126. Now our treasury stock, oh, that transaction wasn't finished. The 250 at $14, 3,500, but we issued at 17. 17 minus 14 is 3. $3 times the 250 will give us the additional paid in capital. So yes, I didn't finish that question. Hence the 750. So now we have 750 in treasury stock as additional paid in capital. Retained earnings, beginning plus net income minus dividend, 99,500. Treasury stock, we started with negative 42, we reclaimed 3,000 more, but we reissued 35, so we're left with negative 3,700. When it comes to treasury stock, when you're reclaiming, it comes in negative. When you reissue, it goes out positive. Any questions? The only thing here that might have been a little challenging is that FIFO thing. So when you see about treasury stock and they say FIFO, it means the stock that they're issuing, they're going from the oldest one, it's like inventory, first in, first out. So you had 3,000 starting at the 300 at the beginning of the year, that's where that 250 will come from. Any questions? Two. Two, it says, compute the return on shareholders' equity for 2019. So when we are calculating the return on shareholders' equity, it's our net income divided by the average shareholders' equity. What was the net income of the period? 46,500. Average shareholders' equity, the beginning of, where is it? I'm going to add these now. 150,000 plus 180,000 plus the 71,000, the 126, the 750 plus the 9, all of that minus will give you 623,000. So what do we want? The ending and the beginning divided by 2. In other words, 623,550 is 150 plus 180, 71, 26, 750, 99 minus. And this 508,800 is your beginning. But I don't think we need to add them up because it gave us from the balance sheet what is the total shareholders' equity. So beginning shareholders' equity plus ending shareholders' equity divided by 2 will give you the average shareholders' equity of 556,175. So you divide and our return is 8.2%. Any questions? Any questions? The next question, is it this one? The weighted average shares, 16.13. At the beginning of the current year, Hardin Company had 20,000 shares of $10 per common stock outstanding. During the year, it engaged in the following transactions related to common stock. So at year end, it had 63,800 shares outstanding. So they have given us all the transactions during the year. We have to determine what is the weighted number, average number of shares outstanding for computing earnings per share. Here, April 1st. April 1st was the first transaction for the year. But prior to April 1st, we had 20,000 shares. So therefore, these 20,000 shares, how many months did we have them before anything happened to them? We had it for the full January, February, March. Actually, let's redo all that. So we see that on April 1st, we issued 5,000 shares. So that's going to increase. June 1st, we issued 4,000 shares. That's going to increase. July 1st, we had a 10% stock dividend. Now remember, when it comes to the stock dividend, when it happens during the year, we assume automatically it took in effect from the first of the year. So we have to take that 10% into consideration. Then September, we had a 2-for-1 split, reducing the par value of 5. So when there is 2-for-1 split, or when there's stock split, even though it happened on September 30th, we assume that it happened at the beginning of the year. So those are 2 assumptions. October 1st, we reacquired, and November 30th, we issued. So therefore, what's happening here? Starting with how many shares do we have at January 1st? 20,000. But there's a 10% increase that we're going to do on July 1st. So we're going to assume it took into effect from the beginning. So 20,000 times 1.10, that's 110%, that's saving. And we also have a 2-for-1 stock split September that we're going to assume happened at the beginning of the year. So therefore, our actual shares of 20,000 times 1.10 times 2 will give us assumed shares of 44,000. How many months did we have that 44,000? January, February, March. 3 over 12, therefore, the equivalent whole units is 11,000 shares. April 1st, we issued 5,000. After that, June. So it means that additional 5,000 will increase our stock base to 25. Because we have 20 from before, and we're now issuing 5. That 25,000 will get the same assumption of the 10% stocks, that of the 10% stock dividend plus the 2-for-1 split. So 25,000 times 1.10 times 2, which represents the 2-for-1, will give you 55,000. How long would we have this? From April 1st to the next transaction, June 1st. So that means we're going to have 25,000 for the whole month of April and for the whole month of May. So that's 2 over 12. That will give us an equivalent whole unit of 9167. Then, on June 1st, we issued another 4,000 shares. 25,000 from before, plus 4,000 brings us to 29,000. And again, assume the 10% stock dividend and assume the 2-for-1 shares. So 29,000 times 1.10 times 2, 63,008. But how many months? This happened on June 1st. And the next transaction will happen, no, this is June, April, May, July, where we are?
I think it's July 1st.
June 1st for the 4. And the next transaction will happen when?
July 1st.
July 1st. So where do you get 4 months from? From June to July? No. It's not June to July. April. Wait. Beginning.
So it's from April.
So we have 25,000 from
April to June.
April to June, 2 months. When June came, we issued another 4. And the next transaction is July.
Right. They calculated from April instead of from January.
So but from June to July is 1.
Right, it's from April to July, I guess.
Oh,
Yeah.
July 1st is the 10% stock dividend. So, how many months do we have the 29,000? The 29,000 is April, May, June, July. No, something is wrong with this calculation. Hold on. Because from January, February, March, April, May, that's 5. June 1st to the next transaction, July. But how many months did we assume the stock dividend for? This happened on July 1st, which means that's 5 months. No, that's 6 months. That's 4 months, does not look right to me at all.
Okay.
April, May, June, July, that's not, that 4 months for the 29,000 does not look correct at all. Because June to July is 1 month. Can you calculate 1 over 12 times 63,000 for me? And tell me what you get. To make sure that's not a typo.
5,360.67.
Multiply that by 4, that gives you the 21,260.
Yes.
That 4 is really a mystery to me now. Because that doesn't make any sense. The stock dividend was 10% was issued on July 1st. So all the months prior to the stock dividend would have been January, February, March, April, May. 5 months and not 4. Because the assumption happened for exactly 6 months.
Yeah.
So I'm not sure where the 4 is coming from.
Well, the 4 months because they had October 1st, they required over 1,000, which is right there.
No,
So
they said
we have seen
October, don't.
The 4 will come into play.
This students may mistakenly add the 10% stock dividend to the 200% tax split and multiply by the initial instead of the correct 220%. I'm going to have to come back and see why that is 4/12. Because I'm not here in July 1st. That 10%. I'm going to go back and see why that is 4/12 because that not sounding correct to me, but I could have missed something. So I'm going to come back with that explanation. Then we have, oh, they're outside already. So let me leave this question here, go back and check, and then on Friday I will start with this as to why the 4/12. Because I clearly missing something about this. So then we had other questions. What I am going to do, now that we have come to all of the chapters to midterm, I think there's 2 tutorials last week and this one, I will post the solutions on Moodle. But this question, on Friday I'll come back to this as to why. Alright, before you leave, sign the book for me, and once you sign,
Yes.
listen to me, you have to be a doctor or something. Because the way how you use the one of them, and the patient's so easy. Name and signature.